Hello and welcome to CMC's Bitcoin Fundamentals video. I'm Henry Fisher, Senior Content Specialist here at CMC. Whether you're brand new to Bitcoin or already a bit further along on your educational journey, the goal of this video is to give you a clear, high-level overview of Bitcoin. We're going to focus on the big picture rather than getting lost in the weeds. And that's because with Bitcoin, there's a long educational journey. You're not going to know everything overnight. So you can think of this session as providing you with an introductory map of the Bitcoin landscape. I want to provide you with some signposts which may help give some structure as you go about your own educational journey. By the end of this session, there are 5 main things you'll know about. The first is, what is Bitcoin? We're going to break down what Bitcoin actually is and explore some of the different ways people think about it. The second question is, what is money? We're going to take a step back and look at the history and properties of money and how Bitcoin fits into this picture. In part 3, we'll unpack the mechanics of Bitcoin, including blockchain, mining, and how transactions are verified. In part 4, we'll explore some of the most common misconceptions people have about Bitcoin, and I'll also provide an assessment of key risks. Finally, we'll look at Bitcoin's adoption, backed by real-world data and case studies showing how it's being used across the globe. So part 1, what is Bitcoin? Broadly speaking, Bitcoin is an emerging digital technology that enables users to store and transfer value through a decentralized network. Now, I started that definition by saying broadly speaking, and that is because there isn't actually a single agreed upon definition of Bitcoin that exists. You can see on screen here that I've put some definitions from prominent people and players in the space that highlight different perspectives. But if you do a bit of a search on the internet, you'll probably be able to find a much broader range pretty easily. So while there are various definitions of Bitcoin, there are a few recurring themes that tend to emerge around what Bitcoin is. The first theme is that Bitcoin is a form or some form of a monetary system. It allows people to store and transfer value between each other, in this case in a peer-to-peer way. The second theme is that Bitcoin is a software. It is a code or a protocol. In other words, a set of rules enforced by technology that everyone using Bitcoin agrees to. And the third theme is that Bitcoin is decentralized. There is no intermediary or central authority like a bank or government controlling it. It runs on a network of computers distributed across the world. So just to help ground this idea of a decentralized system of rules in some reality, I want to add a note on what a decentralized protocol actually is. So a protocol is, in simple terms, just a system of rules. And the decentralized aspect of decentralized protocols means that there is no single authority or point of failure. So some real-world examples of a decentralized protocol might be the internet. Chess could also be thought of as a decentralized protocol. The English language could also be thought of as a decentralized protocol. None of these 3 things, the internet, chess, or English, are owned by a single person. It is also very difficult to change the rules, say, of chess, or prevent people using certain words in the English language. Also, changes require consensus among all participants, making the system resilient. That said, Bitcoin and decentralized protocols can evolve over time, much like how the rules of chess and English have also evolved over time. So when answering the question of what is Bitcoin, so far we've dealt with trying to classify components of the technology itself. We know, broadly speaking, that one way to approach that is to understand Bitcoin as a kind of monetary network, but also as a software or protocol with certain rules, and thirdly, through its decentralization, it's a decentralized network. However, there is another set of terms that are used to describe, or in some cases define, Bitcoin. And these are terms relating to its practical utility or perceived value. Some common terms you might hear include store of value, currency, asset, medium of exchange, commodity, unit of account, hedge against inflation, Ponzi scheme, alternative investment, scam, tool, network, speculative bubble, and fad. This diverse range of terminology shows how even more varied perceptions and definitions of Bitcoin can be. And the point I want to make here is that applying sort of rigid labels to Bitcoin can be constraining and misleading for a few reasons. I'll give three. The first is that a narrow definition can lead to an oversimplification and a lack of nuance in understanding Bitcoin. So an example of this would be if someone defines Bitcoin as definitively a currency, then they may consider it a failed innovation because in many countries around the world, it's not even being used for daily transactions. People aren't going and paying for their coffee in Bitcoin. However, if someone else sees Bitcoin as an asset, similar to stocks or gold or art, all of which are valued in the trillions, and none of which are used to pay for a coffee, then perhaps Bitcoin does not need to be used as a currency in order to have value. It could just be seen as an asset. The second reason I'll provide is that Bitcoin can serve multiple purposes simultaneously. In other words, an example would be someone in El Salvador, for example, where Bitcoin is legal tender, may be using Bitcoin for transactions, while an Australian investor may be holding it as a speculative asset. Or a migrant worker may be using it for remittances. In Australia, Bitcoin is not widely accepted as a currency, but as I mentioned, in El Salvador, it is. And so you get this sense that around the world, depending on, what people are actually using it for, it can be different things. It can be defined or it can have different purposes to different people. And Bitcoin's adaptability allows it to meet different needs depending on the context. The third reason is that technologies evolve over time. So in the 1990s, people used various, often conflicting terms to describe the internet. They used terms such as an information superhighway, cyberspace, the global village, a virtual community, electronic town hall, an electronic frontier, a digital bulletin board, but also terms like a speculative bubble or a fad. And these descriptions reflect how the internet's purpose and value was not fully understood at the time. And to underscore this, I want to show you a few short clips to illustrate this point about the problems with terminology and how defining technologies by their early use cases or what they appear to be in the beginning can be quite limiting, especially given these technologies will evolve over time. So here are some clips from the early days of the internet.
And why did you buy a computer?
Well, I was very interested in the new technology and didn't want to be left behind. I don't think it's only for the youngsters at school now. I think us older ones will have to learn a lot about it.
And what do you use the computer for?
Well, for keeping household records, such as what I have in the freezer and people's telephone numbers and addresses. I use it as a word processor for my letters, which always come out perfect now. And the most exciting thing I find is the mailbox where I write to other people on the Pressdale system.
Oh, that's
that
right.
little mark with the A and then the ring around it.
At.
See, that's what I said.
Mm-hmm.
Katie said she thought it was about.
Yeah. Oh.
But I'd never heard it.
Around.
I'd never heard it said. I'd always
That's
seen
right.
the mark, but never heard it said. And then it sounded stupid when I said it. Violence at NBC.
Well, Allison should know.
What
do you
is
say to that,
internet
Allison?
anyway?
Internet is that massive computer
Right.
network, the one that's becoming really big now.
What do you mean? That's big. How does one? What do you write to it like mail?
Well, as I mentioned, I have no desire to be a part of the internet because I feel like I'm so inundated with information all the time that I don't want more. Don't you ever feel like it's just constant bombardment?
Just what is this main artery of the information superhighway?
Every business, no matter how large, no matter how small, will be on the internet in the year 2000. It's the primary way that people will look up information. It will replace the yellow pages as we know it today.
Are a lot of people just getting on to the internet because they feel that they have to get onto the playing field, so to speak?
Well, it's very hip to be on the internet right now.
Now, the fact that people were using computers to keep a track of what was in their freezer is telling. If you had to find a computer solely as a tool for keeping on top of your household records, you would have been closed off to its ultimate potential. In the same way with those clips of the internet, there was a wide variety of different terms, and there wasn't one unified understanding of what the internet was at the time, let alone what it would become. In the same way with Bitcoin, there was, and there is, a wide range of views, even among prominent investors and business owners, as you can see on the screen. And part of the job as investors is to navigate this uncertain and nuanced understanding of Bitcoin that we currently have, and that we may not know all the information in terms of where Bitcoin could end up in the future, whether for better or for worse. The key takeaway from this section is that Bitcoin does not have a single universally agreed upon definition. I hope that I've demonstrated some of the core aspects of Bitcoin as a technology and also highlighted many of the different ways in which people view it. Some people see it as a currency, others as a store of value, and so on. Now, the fact that Bitcoin is hard to categorize is a big reason why public opinion on it is so divided. It's easy to dismiss, but to truly understand it, you need to go below the surface and form your own perspective. And this is critical. The reality is that Bitcoin's role is still evolving. Much like how early perceptions of the internet changed over time, as an investor, it's important to approach Bitcoin with an open mind and avoid rigid classifications or oversimplifications. Ultimately, Bitcoin's utility can vary from country to country, user to user, and situation to situation, making it a highly dynamic and adaptable technology. By acknowledging this complexity, you can arrive at a more informed perspective, rather than being swayed by extreme opinions or narrow definitions. Part 2, what is money? I previously mentioned that Bitcoin might be considered as a monetary technology in that a core function it has to serve is as a tool for transferring and storing value. Tools that have served this purpose throughout history are known as money. And if we start to think about Bitcoin as an emerging monetary technology, then in order to fully understand Bitcoin, we need to understand the concept of money and the history of money. Money is essentially a tool that human beings have created that enable us to transfer, store, and measure value. The three main functions of money include money as a medium of exchange, a store of value, and a unit of account. Let's go through these three terms now. So first of all, money helps us trade. It acts as a medium of exchange. Instead of bartering, where we have to find someone who has exactly what we need and wants exactly what we have, money makes transactions smooth and efficient. And second, money lets us save for later. It acts as a store of value. Unlike perishable goods, like food, money can hold its worth over time, so we can earn it now and spend it in the future. And third, money helps us measure value. It serves as a unit of account. It gives everything a clear price, making it easy to compare costs and understand the price relationships between things in a standardized way. So where did money actually come from? That is still a topic of debate, and there's differing views about how and where money emerged. Some economists and historians argue that money developed as a solution to the inefficiencies of barter, especially as societies grew more complex. However, there's little concrete evidence to support this theory. One general theory of money goes something like this. In the early days of human societies, people lived in a communal way. They were sharing and coordinating resources among themselves in smaller bands and tribes. However, somewhere along the line, human beings began to settle in more agrarian style societies, and their relationships between each other, as the people in the society, grew more complex. People began to develop a surplus of food and resources, and also they began to specialize. Over time, some became wheat farmers, others looked after livestock, others caught fish, and so on. Now imagine I'm a fisherman and all I have is fish, and I want to trade my fish for your wheat. The problem is that I only have fish to offer. So if you, the wheat farmer, don't want my fish, then I'm kind of stuck. And this is where money steps in as the common ground, as the medium of exchange, something we both can agree that has value. And so instead of being forced into a direct swap, I can sell my fish for your money and then use that money to buy something else. Another problem with fish is that it spoils quickly. With money, I can sell my fish while it's fresh and store my value in the money and spend it later when I actually need it. And finally, money helps us standardize value. If I'm trading wheat for fish, how would we agree on a fair deal in a precise way? Money gives us a universal way to measure transactions so that they are clear and consistent. So in short, money exists because we needed a way to cooperate and coordinate at scale. And money provides us a medium through which we can trade, save, and measure value in an increasingly complex world. Money has a long history, and it has changed a lot over time. The monetary system we have today in its current form is only a bit over 50 years old. A rough timeline of money looks something like this. We start with the barter system in around prehistoric times, where people are exchanging goods between each other, but that became inefficient at scale. The next phase broadly is commodity money. So in more ancient civilizations, they used salt, cattle, shells, and grains as money. Civilizations soon progressed to minting coins made of gold and silver, and coins were more durable and widely accepted. In around the 11th century, China was the first country to issue government-backed banknotes, and this made trade easier but required trusting in the issuing authority. In the 19th century, we moved on to the gold standard, where many economies pegged their currencies to gold, ensuring stability and limiting excessive money printing. In the 20th century to present, after the collapse of the gold standard in 1971, governments have issued money backed only by the trust in their authority. This allows central banks to control the money supply, but as a byproduct can also lead to inflation. And now as we move into the 21st century, the rise of the internet and blockchain technology, digital payments, stable coins, decentralized currencies like Bitcoin have emerged, which may form the next leg of monetary innovation. Obviously, this is a very simplified list, and there's a lot more information you can find on the history of money. But the key point I'd like to emphasize is that over time, different types of money have come and gone. Some have been stronger forms of money in that they have functioned reliably for longer periods of time and preserved value over time. Others have been weaker money and have been more short-lived. So the question is, why do we have stronger and weaker forms of money? And historically, stronger forms of money have shared a range of key characteristics, and these include durability. The money should be able to withstand the test of time and not degrade. Portability. It should be easy to carry and transfer. Divisibility. We should be able to break the money down into smaller units. Fungibility. Each unit should be interchangeable with another of the same kind. Scarcity. It should be limited in supply to maintain value. And acceptability. It should be a widely accepted means of payment. The strength of a money depends on how well it meets these properties. So gold, for example, which has been used in some way, shape or form for around 5,000 years, up until the 20th century, or in many ways it is still used today in economies with central banks, and individual investors can buy it as well. Gold has been trusted because it's highly scarce. It does not degrade. Mining new gold is also significantly harder to do than breeding cattle. If cattle were our money, everyone could just, have a cattle farm and be raising as many cattle as they want and just increasing the supply a lot. Whereas with gold, given how scarce it is, it actually is quite difficult to go. You can go and mine gold, but you can only increase the supply by a small amount each year. And if money can be created easily in large amounts, then it loses its fairness and stability, which can be detrimental for society. So from ancient Rome to Weimar Germany, the collapse of currency has often preceded, or at the very least coincided, with the collapse of societies and empires. Another point I'll make here is that people often say that money is just a construct of our minds. In other words, if we all believe in it, then it will work. Or if we stop believing it, then it will fail. And there is some truth in that idea. However, it's not the whole picture. And the reason it's not the whole picture is because belief may be a component to money, but history has shown that money also has a physics to it. It has physical properties that are important. In other words, believing that your car will fly does not make it fly. It's still subject to gravity. And in the same way, with money, if everyone in the world believed and truly believed that our new money should be leaves from trees, that wouldn't work for long because there are so many different types of leaves. It's not fungible. The leaves are also, they're portable. We can easily carry them around, but the problem is they're not durable. They'll perish. They'll sort of rot away. And they're also not scarce because, as I said before, with the cows, people might just plant more trees in their own yard and expand the money supply infinitely, and money will, be literally growing on trees. So this brings me to the question of how is Bitcoin different? Bitcoin is an interesting point of evolution in the history of money. As this diagram from Fidelity shows, at least in their estimation, Bitcoin has a range of strengths compared to gold and fiat currency when we look at some of the characteristics of money that I've described earlier. And I'll just highlight a few of these. So with Bitcoin, it is digital. We can move it wherever we want. We can send it easily. We don't have to carry it around in our pockets. We can divide it up into, millions of pieces. It also has absolute scarcity. So it has a fixed supply. It cannot be arbitrarily increased by a central authority. On the gold standard, people could just mine more, or on the fiat standard, people could, create more fiat dollars. Bitcoin is also decentralized. So throughout history, money has typically been controlled by a centralized entity like a king or a government. So you just have to trust them. Whereas with Bitcoin, it's distributed. So we don't have to trust an individual or an authority. So to conclude this section on what money is, what is money, the main takeaway is that one way to view Bitcoin is as an emerging form of money. Money has a function, a history, and characteristics that determine its quality. And Bitcoin possesses characteristics that distinguish it as a significant evolution in the history of money. Exploring the history and functions of money can help you understand Bitcoin's place in the broader context of economic history. And the fact that money evolves over time, shaped by changes in society and technology, is a powerful starting point for deeper investigation. Part 3, how does Bitcoin work? Bitcoin can feel like, and it is, I guess, a very technical topic. So I want to use this section to distill down 4 key concepts which will help explain how Bitcoin works. And they are blockchain, mining, supply, and halving. So firstly, let's touch on blockchain. Bitcoin runs as a software on thousands of computers all around the world. And these computers, or the computers running this software, are called nodes in the Bitcoin network. and anyone can run the Bitcoin software and become a node. According to BitNodes, there are around 22,000 nodes operating globally right now. Each of these nodes holds a complete copy of every Bitcoin transaction ever made. This history or record of transactions across a peer-to-peer network is called the blockchain. Think of it like a shared ledger that records every time Bitcoin changes hands. To make this easier to imagine, you can picture a Google spreadsheet that lists every single transaction. Every node has view access to this same sheet, and whenever a new transaction happens, this sheet updates across all nodes so everyone can see the same thing. But there is a key difference, of course, and that is that a Google Sheet is stored and controlled by a central company. Bitcoin isn't, and removes that trusted third party. It's truly decentralized, which means that the software isn't hosted in one place or run by one company. It's distributed across thousands of computers worldwide. Now, you don't need to run a node to use Bitcoin, just like you don't need to own a mobile tower to make a call on your cell phone. Nodes are, in a similar sense, part of Bitcoin's infrastructure. They are the mobile phone towers, perhaps, of the Bitcoin network. Some companies like Coinbase run nodes, and individuals run nodes as well, and those who want to verify their own transactions and help secure the network. Next is mining. So, miners are a special type of node in the Bitcoin network. Their job is to process and add new transactions to the blockchain. You can think of them as having the privilege of adding new rows to that shared Google Sheet I mentioned earlier. So what is Bitcoin mining? Bitcoin mining is essentially the process of validating transactions and releasing new Bitcoin into circulation. Just like how MasterCard processes card payments and charges a fee, Bitcoin has its own network where miners are doing that processing. But what makes Bitcoin unique, unlike MasterCard, is that the Bitcoin network doesn't just process transactions. It is also actively engaged in the process of creating new Bitcoins as part of that process, or bringing new Bitcoins into circulation. These transactions that the miners process are grouped into blocks, batches of around 2,000 transactions or so, and a new block is added roughly every 10 minutes. When that happens, miners receive a block reward for their work. And that block reward includes both newly created Bitcoin as well as transaction fees that are paid by users. So when a user sends a transaction over the Bitcoin network, there'll be a small fee that will go to the miners. So you might be thinking, hang on a minute, the miners are processing transactions and are earning a transaction fee. That makes sense. But they're also receiving newly created Bitcoin as a reward. That means the supply is increasing. Isn't Bitcoin meant to have a fixed supply? Bitcoin's supply is capped at 21 million units. That's the maximum number that will ever exist. Each Bitcoin can be split into tiny pieces, up to 100 million units, called Satoshis, named after the founder. People often talk about Bitcoin's fixed supply. And while that is true in the long run, it is important to note that Bitcoin's supply is still increasing, just very slowly and on a predictable schedule. No central bank or authority can change it. So as you see this supply increasing, this is the miner reward getting less and less over time. Similar to how gold works, the total amount of gold on the world is finite. But we keep mining small amounts each year. With Bitcoin, however, no amount of increased demand can lead to faster production, and that's one of the things that makes it unique. Finally, the halving. The halving is a built-in feature of the Bitcoin software, which relates to the mining supply decreasing over time that I mentioned earlier. Every 210,000 blocks, which works out to roughly every 4 years, the number of new Bitcoin created in each block is cut in half. So the question is, why design Bitcoin this way? Satoshi Nakamoto, the anonymous creator of Bitcoin, wanted to design a system where the incentives would evolve over time. If all the Bitcoin had been released on day one, there'd be no motivation for miners to support the network early on. And on the flip side, if Bitcoin had an unlimited supply, it could face inflation risk, just like many government currencies do today. A halving cycle every 4 years strikes a balance. It slows the growth of the supply over time while still rewarding those who help maintain the network. And as the network grew, more miners joined in, and that increased usage helped drive the price growth. As Satoshi put it back in 2009, instead of the supply changing to keep the value the same, the supply is predetermined and the value changes. As the number of users grows, the value per coin increases. This creates a kind of positive feedback loop. More users drive up the value, and the higher value attracts more users. I hope this has given you a solid but broad overview of some of the different components that you need to understand when thinking about how Bitcoin works. At the end of the day, Bitcoin is a complex system. It's built on cryptography, decentralized computing, and a lot of intricate technology under the hood. Now, there are many other aspects to understanding how Bitcoin works, including cryptography, private keys, wallets, and the like. And these are all great areas to explore when you're diving deeper into Bitcoin. Regardless of how you wish to access Bitcoin, I would note that you don't need to become a computer scientist or a cryptographer to invest in it. A lot of people get caught up in technical details. If you think about an iPhone, you don't need to understand how the circuit boards work inside of it in order to invest in Apple stock. You don't have to have a PhD in the technicalities of battery chemistry or self-driving AI to invest in Tesla stock or appreciate how that technology may have an impact on the world. So if the technical side feels overwhelming, that's completely fine. Understanding Bitcoin takes time, and as you learn more, you'll develop a clearer perspective that will help you navigate the risks and fully appreciate the realities involved. And that brings us to our next section, Part 4, Misconceptions and Risks. In this section, I want to unpack some of the common misconceptions surrounding Bitcoin and provide a balanced assessment of the risks involved. As we touched on earlier, understanding Bitcoin can be challenging, and that's partly why so many misconceptions exist. Also, like with any other asset, Bitcoin comes with real risks. Some are short-term, while others may play out over the longer term. Let's start with Bitcoin misconceptions, which I'm going to call myths here. The first myth is that Bitcoin is a haven for criminals. One of the most common myths is that Bitcoin is primarily used for criminal activity, like money laundering or illegal transactions. Now, it is true that some crime has occurred on the Bitcoin network, and it would be naive to say otherwise. But the idea that Bitcoin is a crime hub is extremely exaggerated. In reality, traditional cash remains the go-to choice for illegal transactions. According to reports from the United Nations, cash is still used far more frequently and in much larger volumes than Bitcoin for money laundering and other illegal activities. Unlike cash, Bitcoin operates on a public blockchain. Every transaction is recorded on a ledger that authorities can track with the right tools. This makes it far less anonymous than what people assume. It's not the easy, untraceable escape route for criminals that some claim it is. There's also a myth that Bitcoin can be used as a way to evade taxes. But tax authorities worldwide are already working with exchanges to track and regulate Bitcoin transactions. While your Bitcoin is pseudonymous, in other words, your transactions are linked to wallet addresses, not names, know your customer rules, KYC, make it increasingly easy to trace who's behind a given transaction. The second myth is that Bitcoin is a scam. So as we've covered in the first section of this presentation, people have used terms to describe Bitcoin like bubble, Ponzi scheme, and a get-rich-quick scheme. But if we break these terms down and also investigate the technology of Bitcoin, we find that these don't really map up that well. So for example, if we look at a Ponzi scheme, Bitcoin's price has, of course, been influenced by money flowing in. But people investing in something does not alone make it a Ponzi scheme. If price increases and money flowing into an asset driven by demand meant something was a Ponzi scheme, then many other assets like stocks and housing would meet the definition as well. A Ponzi scheme, on the other hand, typically requires a central organizer profiting at the expense of later investors. Bitcoin doesn't have that central organization. There's no company or single entity at the center controlling it. It's code-based, it's open source, and it's widely audited by experts, make it one of the most transparent financial systems ever created. Myth 3. Bitcoin has no intrinsic value. The idea of value or intrinsic value is often misunderstood. According to Austrian economists like Karl Menger and Ludwig von Mises, which are quite popular in Bitcoin circles, nothing has value in isolation. Value is always contextual, shaped by perception, utility, and scarcity. In other words, the worth of goods and services does not arise objectively in those items themselves, but rather in the evaluation of individuals. Take gold, for example. It's often said to have intrinsic value because it's historically revered, it's physically tangible, and it has industrial applications. But if you were stranded alone in a desert and had to choose between a gold bar and a bottle of water, the gold would be useless to you. The water would hold far greater value in that situation. In other words, value is context dependent, and even so-called intrinsic value isn't absolute. Generally speaking, the same principle could be applied to all assets. For some people, a house has value because they need shelter, just as brand names, intellectual property, and digital goods can have immense value despite being intangible. Bitcoin, like gold or real estate, derives its worth not from a single inherent quality, but from factors like how useful it is to people in a given situation. For Bitcoin, its value in the eyes of some beholders revolves around its utility as a store of value, its ability to transfer wealth across borders, its fixed supply, and the network effects of more people joining the ecosystem. While there are plenty of misconceptions about Bitcoin, it also comes with genuine risks. Some we can identify today, and others may only become clear in the future. In investing, risk is often best understood as the possibility of permanent loss of capital. And with that in mind, here are some of the ways Bitcoin investors could face risks in the future. The first risk is volatility. Bitcoin's price swings are dramatic, making it potentially a high-risk asset. Historically, Bitcoin has experienced significant drawdowns with price declines of 70, 80, or even 90% during bear markets. These extreme fluctuations mean that if an investor buys Bitcoin at a peak and needs to sell during a downturn, they could face substantial losses. The second is government regulation and bans. Some critics of Bitcoin argue that if Bitcoin becomes significantly larger, governments aren't just going to sit by and let it challenge their national currencies. This is still an open question. Countries with strong financial systems have the power to regulate, tax, or even attempt to ban Bitcoin. While an outright ban may not be effective in banning Bitcoin on the whole, increased regulation could limit Bitcoin's appeal or usability in certain places. The third risk is around complexity and adoption barriers. For the average person, Bitcoin can be overwhelming. Managing private keys, understanding digital security and cryptography are all unfamiliar challenges. If Bitcoin is to achieve widespread adoption, these barriers will likely need to be addressed through more user-friendly solutions. Even then, adoption is far from guaranteed. Crucially, the success of Bitcoin would also, to some extent, depend on a cultural shift. People must actually want to take control of their own money, rather than continuing to rely on trusted third parties. Following on from this, there are also no refunds or recovery options with Bitcoin, which may be seen as an adoption barrier to what we're accustomed to. If you lose access to your Bitcoin, it's gone for good. And perhaps technology can play a role in helping solve for this. Number 4, infrastructure risk. Bitcoin relies on a range of different pillars to work, including energy, the internet, and advanced hardware. In extreme cases, a major cyber attack, power grid failure, or geopolitical crisis could impact access to Bitcoin in some regions over the short to medium or even long term. That said, our existing financial system and other technologies have the same vulnerabilities. The final area of risk I'll touch on is technical risk, and more generally, future uncertainty. There's always the possibility of unforeseen technical and societal challenges. For instance, in the far-off future, roughly in the year 2140, Bitcoin mining rewards will disappear, raising questions about network security. Advancements in quantum computing could theoretically break Bitcoin's cryptography. Also, Bitcoin needs to scale to handle mass adoption efficiently, and this could have issues. If Bitcoin became a dominant currency, its fixed supply might encourage people to hold it rather than spend it, reshaping economic dynamics, which is a common critique. Another concern is inequality. Given early adopters hold a significant share of Bitcoin, this could potentially lead to wealth concentration and public outcry. There are also concerns about the centralization of Bitcoin. If it never evolves into a widely used currency and instead becomes primarily held through ETFs or by large custodians as a passive asset, this could create a choke point. In that scenario, governments may find it easier to regulate, restrict, or even confiscate assets, potentially undermining Bitcoin's core principle of decentralized ownership. A historical parallel can be seen in the United States between 1933 and 1975, when it was illegal for citizens to own gold bullion as an investment. The government effectively removed personal control over gold holdings, illustrating how state intervention can override individual asset ownership. When we try to look out far into the future, it's tough to imagine what life will be like in 10 years from now, let alone 50 or 100. We just don't know how society will evolve, how economies will function, or even if money and assets will hold the same value as they do today. Will our assumptions around labour, value, and technology change? And that uncertainty doesn't just apply to Bitcoin. It's something we face with every investment we make. I want to conclude this section with a bit of perspective. One thing to keep in mind, and it's something I find interesting, is that people often hold Bitcoin to an extremely high standard that they don't apply to other investments. They ask questions like, well, what if something terrible happens in 2100? What if a meteorite destroys the entire world and wipes out Bitcoin? I've touched on this earlier, but extreme risks can apply for every technology. In 20 years, could a competitor invent a flying car that makes Tesla cars obsolete? Potentially. But the chance of that happening doesn't stop people from considering Tesla as an investment right now based on available information. At the end of the day, Bitcoin is an evolving technology with real risks, but also with real potential. The key is to stay informed, assess risks rationally, and make decisions based on the best information available today, rather than fear of the unknown. On the flip side, while risks exist, we should not overlook the positive changes Bitcoin could have. It could boost financial inclusion, offer a stable alternative to inflationary currencies, and empower individuals in authoritarian regimes through its transparency and censorship resistance. And that leads me into our final section, Part 5, Bitcoin in the Real World. We've talked a lot about Bitcoin in theory, but in this final section, I want to bring us into the real world. How is Bitcoin adoption actually playing out? Who's using it? And why does it matter? Let's start by looking at the scale of Bitcoin adoption. Estimates of cryptocurrency ownership can vary a lot, and there are a few reasons for this. It's actually pretty hard to get an accurate number because people could own multiple Bitcoin addresses. For example, one person might hold Bitcoin in 5 different wallets, but there's no way to tell if that's one individual or 5 separate people. On the other hand, a single company could have millions of clients storing their crypto with them. But if all those funds are held in a single wallet, those millions of users aren't captured in the ownership data. At the end of 2021, it was estimated that nearly 300 million people worldwide owned some form of cryptocurrency. Fast forward to 2024, and that number has almost doubled, according to some estimates, with around 562 million people now owning some type of cryptocurrency. That's around 6.8% of the population. Bitbo estimates as of 2024 that around 106 million people own Bitcoin. So if we say that around 100 million people in the world have some Bitcoin, how many people are actually using the Bitcoin network? According to on-chain data from Bitcoin Magazine, if we look at active addresses, which refers to wallets that are actually making transactions on the Bitcoin network, there are around 800,000 active addresses at the time of this recording. Now, it's important to note that these active addresses refer only to the wallets that are moving Bitcoin around, sending and receiving transactions. A majority of the Bitcoin holders aren't actually transacting frequently. They tend to be holding their Bitcoin for the medium to long term instead. And this makes it even harder to get a true sense of adoption just from transaction data. To summarize, Bitcoin adoption is growing, but the exact number of users remains uncertain. What we do know is that a significant number of people are using it today. I want to turn now to discuss Bitcoin and economic freedom, which is a really important part of Bitcoin's real-world potential. Only around 13% of the world's population was lucky enough to be born in a country that has a liberal democracy and has a stable reserve currency. That means that more than 85% of the people in the world, over 6 billion people, live under either a weak currency or an authoritarian rule. Many of these people don't have access to a bank, let alone investment opportunities. Bitcoin offers a way to preserve purchasing power. With just a smartphone and an internet connection, individuals can receive, store, and send Bitcoin globally without needing permission from a bank or government. That's pretty revolutionary. And in this sense, Bitcoin is, for many people around the world, not just an investment. It's a lifeline and a tool of economic empowerment. It's a way to store and move value without government interference, and this could shift more and more control from governments to individuals. Some Australians might ask, why do we even need Bitcoin? Our financial system works. We've got property rights, stable currency, and plenty of ways to transact. However, even in the developed world, our money supply is increasing rapidly. It's just far worse in the developing world. In Venezuela, in Turkey, in Argentina, Nigeria, there's been rapid devaluations throughout history, and capital controls can make it hard for people to send, receive, or store their money. And you can actually track the devaluation of the developing world currencies against Bitcoin in the Google search. Here is the price of Bitcoin as measured in 1 Nigerian naira. The meaning of this is that the naira has devalued at a significantly greater rate than the US dollar against Bitcoin. In some of the developing world, Bitcoin is used as the equivalent of a bank account, a hedge against inflation, or as a low-cost way to send money across borders. Money is a fundamental tool in our society. History and the present both show that when we lose trust in a currency, we can't plan for our future. Economies collapse and people suffer. The final thing I'll note in this section is that Bitcoin adoption isn't just happening at the individual level. We now have Bitcoin on Wall Street. Bitcoin ETFs are now available, making it easier for traditional investors to gain exposure. Companies like MicroStrategy and many others are holding Bitcoin as a treasury reserve asset. And there's also nation-state involvement, whether it's countries like El Salvador, as I mentioned earlier, but also America recently establishing a Bitcoin strategic reserve. At the end of the day, when we're looking at the global picture of Bitcoin, Bitcoin adoption is not just about an investment. It's much bigger than that. It's about freedom. It's about giving people a bank. It's about a new alternative, a permissionless, borderless, censorship-resistant form of money that anyone, anywhere can use. Now, to wrap this up, here are some resources that I've found valuable, and I will link to more below in the description. There are literally hundreds of articles and books out there. The Bitcoin Standard is the standard starting place for many people on the Bitcoin educational journey, but there's a whole range of, longer form YouTube videos, podcasts, essays that are great, and you'll kind of find those as you go along and see where your curiosity leads you. So in conclusion, Bitcoin is a fast evolving technology that challenges how we think about money, value, and financial freedom. Should more individuals, institutions, corporations, and even governments adopt Bitcoin, its role in the global economy will likely continue to grow. As for what Bitcoin is or becomes, That's up to us, and the overall impact and the degree to which it is successful will depend on how we all choose to adopt it and integrate it into our lives. As an investor or trader, it's crucial to approach Bitcoin with an open and agnostic mindset. Rather than getting caught up in the hype or dismissing it altogether, focus on your educational journey, assessing the risks and recognizing the broader context. Thanks for joining me to learn about the fundamentals of Bitcoin. If you've got a comment or a question, feel free to leave it below and I'll get back to you. All the best on your Bitcoin journey.